In this class we're going to talk about calculating margins. Now this is an important topic because the margins that the company set will help to determine the price that they get in the market, and the price in the market of course will determine the revenue that the company receives, because the price will partially determine the amount of sales, and the revenue will partially determine the profitability. So when we talk about margins, we're talking about an important concept. But let's run through it in very basic format here and get a feeling for what we mean by calculating margins. Margins play a crucial role in determining sales, pricing and promotion decisions. So setting margins is very important, and this requires insight on the part of the management to set appropriate margins and to see if they're able to set prices correctly. Once the prices are set correctly, they're able to work out what their margins are in terms of percentages. But they need to set the prices, and the prices will generate sales in conjunction with, of course, the all important marketing effort. It'll also depend, of course, on the activities of the competitors, the disposable income of the consumers, and so on. But setting the price will ultimately lead to some revenue within the business, and that revenue can then be used to calculate the margins. And once the margins have been calculated, if the other companies, say the competitors, perform the same calculation, then we would have a basis for comparison between the companies to see who's doing better. Despite the fact that some of the companies may be bigger than others, some may have more employees, some may have more modern equipment, we could still be able to compare across them, because we're ultimately dealing in percentages, or we're dealing in measures, which in a sense gets rid of the complication of size or technology or that sort of complication. Information gathered from margins help sales management budget and forecast. Once the margins have been calculated, once the company has set itself an objective of trying to achieve a certain margin, has set its price is accepted in the market as being a reasonable price, and consumers are buying the product, and so on, then once the accounts are drawn at the end, the revenue can then be calculated and margins calculated. Then that information can go back to management, and perhaps back to the sales team, who can then use that information to develop strategies for the next round. Margins provide an overall picture of financial performance. The sales team can use financial information to assess the effectiveness of their sales activities. After all, it's the sales team who have perhaps ultimately suggested the price. It's the sales team who have positioned the product in the market. It's the same sales team who have taken on the competition and tried to develop strategies to win within the marketplace. The degree to which they are successful is reflected within the calculated margins, which are calculated once all the revenue and once the figures are come back to the company and the margins are calculated. That is a measure of their success or failure. There are various margins the sales team can use to assess the effectiveness of their sales programs. For example, they could look at profit margins, gross margins, operating margins. And so we have three. Now, profit margins. Well, profit margin is the measure of profitability and the most common margin used in the assessment of financial performance. We often talk about profit margins. This is where it fits in. This is where the term is used. Sales management can assess profit potential at three levels. So our simple expression of talking about margins has suddenly got a little bit more complicated. Now we have three different types I've just mentioned, and now we're operating at three different levels as well. For example, gross profit, operating profit, and net profit. So we have quite a few complexities now creeping in to this concept of margins. Now, calculating the margins. Well, profit margins. Net profit margins are calculated as net profit margins equals net profits divided by revenue. Profit percentage is calculated as net profit divided by cost price times 100. So quite a big difference in the calculations. So profit percentage and net profit margins are calculated a lot differently. So you have to be very careful about what we mean when we talk about margins. What type of margin? How is it calculated? Now, gross margins. Well, gross profit margin is also a profitability measure and provides an overview of the company's profit after deducting the cost of goods sold, known as COGS, cost of goods sold. So the profit margin is also a profitability measure. It provides an overview of the company's profit after deducting the cost of goods sold. Gross profit margins only concentrate on profits after COGS and do not account for expenses, raw materials, operating costs, taxes, wages, overheads, or any other expense. So they only concentrate on profits after the cost of goods sold. The margin is important as it provides information on setting pricing decisions and expected profit. So gross margins are useful for the sales team, in particular the sales team, because the sales team are able to gauge how well they've done by using this particular calculation. So looking back on the previous time period, they're able to say, well, that was the return in that time period, and they know whether that's good or bad, and they know what the trend is, if it's getting better or getting worse. Gross profit margins, or margin, is calculated as revenue minus COGS over revenue times 100. So that's the gross profit margin percentage. The unit margin calculation is the selling price per unit minus the cost per unit. That's the unit margin. So it's the selling price minus the cost per unit. The margin percentage is the unit margin, it's the one just in front of it, just above it, divided by the selling price per unit times 100. So you can see there are different measures of margins here. We need to be very precise as to which one we're talking about. It's advisable for you to write these down and make clear distinctions between them and know the difference between them. Now, operating margins. Well, operating margin looks into the day-to-day expenses of the business. So it looks into what's happening within the business. What are the various expenses that the business are incurring? The margin is concerned with overheads, operating and administrative expenses. The operating margin calculation, well, it's the operating income divided by revenue. I think instead of saying operating income, operating expenses might be better there. I don't think income is perhaps the right word. But the operating expenses divided by revenue, I think, is a better way of putting that. and that would be the operating margin. So cross out income and write in expenses. But the point is, that's the series of various measures of margin that we can calculate. The most popular, of course, being the net profit margin. That's the one we most likely think of. But the whole purpose of this short class was just to talk about different types and how they're calculated. And it's worth making a note of these. Just be aware that there are different calculations that could be used. And when we talk about margins, we need to know exactly which one we're talking about. Otherwise, we may be at cross purposes. But that's all we need to do here, so let's leave it at that and say thank you for watching.